Welcome. Today we're going to look at Chapter 4, which deals with accrual accounting. In this chapter, we're going to review the accounting cycle, steps 5 through 9. So let's get started with the screen share so I can show you my notes as we go along. Once again, we are using the PowerPoint slides that were provided by Wally, but I've modified this for our particular lecture over here. So as I said, the accounting cycle starts with analyzing a business transaction. Once we decide that this is a transaction that needs to be in the books, we will record it in the journal, post it into the ledger either at the end of the day, end of the week, end of the month, and then prepare a trial balance. Now, before we can get to the step of preparing financial statements, we have to deal with adjusting entries, and that's where we start this chapter. So in this chapter, what we're looking at is the issue of revenue recognition. The issue that arises over here is if the cash received and the performance of the services do not happen in the same period, at what point of time should we recognize revenues? Well, it depends on whether we are using the cash or the accrual basis of accounting. So companies recognize revenues in the accounting period in which the service obligation was performed or satisfied. This is basically saying that we're using accrual accounting. So why do we do that? Well, we do that because that's how it is done in this country, following GAAP, that's generally accepted accounting principles. Now, whatever happens with revenues, the same is going to happen with expenses. So the expense recognition principle states that we match expenses with revenues in the period in which the company makes an effort to generate those revenues. A lot of words over here, it basically says, let the expenses follow the revenues. And as we go through examples, it'll become a lot clearer what this means. So as I said, we are following GAAP, generally accepted accounting principles. And the main reason we have this issue is that we have to prepare financial statements on a periodic basis. We have to give a report card, so to say. It's basically similar to you join college. At what point of time do we assess how you have done in college? Should I wait for 10 years after you're done with college? Should I wait for the end of 4 years? No, what we do is at the end of each semester, we give you a report card. So the exact same idea over here. The economic life of a business can be divided into artificial time periods. And the accounting rule states that you have to prepare financial statement at least once a year. Publicly traded companies are actually required to prepare them 4 times a year on a quarterly basis, plus their annual report. So that's what we're looking at over here. We have come to the end of the month, and I want to assess how we have done. A revenue may not have been earned, an expense may not have been incurred, but cash transactions may have happened. So that's what we're going to try and reconcile in this chapter. So if I was using cash-based accounting, which no business uses, revenue recognition happens when the cash is received. So if a customer pays me cash today, and I say I will do the tax returns the next month, I'll prepare their tax returns next month, I recognize the revenue in the current period because the customer paid me cash today. That's if it's a cash basis. If it's the accrual basis, we say we cannot recognize it as a revenue as yet. I have to wait until next month when I actually prepare the tax return, and at that point of time, I will call it a revenue. An expense. I paid for, a good example would be rent. I paid for 3 months rent, the next 3 months. When am I going to receive the benefit over the next 3 months? When should I recognize it as an expense? If I'm using cash-based accounting right now, I recognize rent expense for the entire 3 months all at one time. If I'm using accrual basis, I postpone the recognition of the expense to the future period when I get the benefits. So at the end of the first month, I say I got 1 month's benefit, so that's rent expense for the month. Second month, I will say this one third is recognized as rent expense. And then finally, in the third month, the last 1/3 is recognized. So we are looking at a timing difference over here. So the need for adjusting entries over here is to ensure that revenue recognition and expense recognitions are followed the principles. We are required every time we prepare financial statements to do the adjusting entries. And what you will also see is in all our adjusting entries, at least one income statement account and at least one balance sheet account is going to be affected. So income statement would mean revenue or expense. Balance sheet is asset, liability, or owner's equity. It's usually your asset or liability, but we'll go ahead and see some examples. So now let's again go to this revenue recognition and expense recognition and the timing issue. So we are concerned with cash transactions. As it relates to expense, what happens when we have an expense? We have to pay cash. We being the business, there's going to be a cash outflow. If it's revenue, it's going to be a cash inflow. Now the question is, for the expense, did I pay before or after I got the benefit of that expense? Revenue, did I get the money? Did I receive the money before or after I performed the services? So if I receive cash before the event, okay, if for expense it'll be paid cash, for revenue it'll be received cash. So if I paid cash before the event happened, should I recognize the expense right now? And the answer is no. I will defer the recognition of the revenue. So what do I call it right now? I know in my journal entry cash credit, I paid cash. What should I debit? What I debit is an asset, and the asset will be the prepaid expense. So if it's rent, it's prepaid rent, it's an asset. So let's take an example now. I start a business and I sign a contract with Verizon. Verizon tells me that I have to prepay, since I'm a new business, I have to prepay for this particular service. So when I pay ahead of time, I'll call it prepaid utilities debit and cash credit. Now, let's take the flip situation. I received money in advance. Question is, have I earned the revenue? Answer is no, because I have not yet delivered the service. So what account should I create in my books to recognize this cash that I've received? I know cash is going to be debited, so I need something to be credited. And that something basically is representing a liability, because until I perform those services or deliver the goods to my customers, it's a liability in my books. So come up with the most logical name. Don't get creative. Most logical name. I have not yet earned the revenue. So what should I call it? Unearned revenue. So cash debit, unearned revenue credit. So in the case of an expense, I created an asset. The asset is basically saying, I will get the benefit of the Verizon services over the next 3 months. If it's unearned revenue, I'm basically saying I have got this money ahead of time from my customer. I have not yet earned it. When I deliver the services, I will not get money because I already collected money in advance. That's unearned revenue. So you will see in case of deferrals, I created an asset for an expense and I created a liability for the revenue that needs to be deferred. Now, cash transaction, it happens after the event. So with an expense, what would it be after the event? After the event is, I already got the benefit. So go with the same example of Verizon. They tell me that I'm a good customer. I don't need to pay ahead of time. At the end of the month, they'll send me a bill and I have to pay the following month. So December 31st, let's say I start my business on December 1st. December 31st, when I receive a bill, I don't have to pay it as yet, but I did get the benefit. So in this case, it'll be utilities expense debit because it's already an expense, and I'll write utilities payable. So in this case, I've created a liability. I got the benefit, I still have to give something. In case of revenue, I already did the work. I delivered the goods or services. The customer has not yet paid me. I sent them a bill, they will pay me next month. So is it revenues? The answer is yes, it's revenues. Have I gotten the cash? Not yet. Okay? So what I'll do is I'll create a receivable in my books. And the most generic account name we use is accounts receivable. So if it's relating to your main line of business, we just call it accounts receivable debit and revenues credit. Once again, if it's a deferral for the expense, I create an asset. prepaid utilities. For revenues, I create a liability, unearned revenues. If it's an accrual, accrual means I already accrued. The event has happened. I got the benefit of the expense, but I have not yet paid, so I create a liability in my books. In case of revenues, I have already done my work. I deliver the goods or services, but I have not yet got paid, so I create an asset in my books. So this is the gist of this chapter 4. All your adjusting entries are based off this particular slide that we're looking at here right now. Okay, so let's take a look at a quick example. On Jan 1st, I prepaid 12 months worth of rent. $1,000 per month. The landlord said I have to pay for the whole year. So prepaid rent debit, cash credit. At the end of each month, I'll have an adjusting entry. Rent expense debit, prepaid rent credit, $1,000. That's 12,000 divided by 12 because I told you this was 12 months worth of rent. So this journal entry is going to repeat 12 times during the year until all of this asset, prepaid rent, is used up. I'm getting the benefit out of it. Some other examples of prepaid expenses are supplies. When a company purchases supplies, they don't debit supplies expense immediately. They debit an account called supplies, which is an asset. They credit cash. And as and when they use the supplies, they will expense it. Now let's look at another example over here, and this is relating to revenues. The landlord has collected 12 months rent in advance. So in the books of the landlord, on the same day, the corresponding entry is going to be cash debit. Remember the tenant said cash credit? The landlord is going to say cash debit and unearned rent revenue credit. They've not yet earned it. When do they earn it? At the end of each month, they're going to start recognizing the revenue. So unearned rent revenue, the liability gets debited to decrease it, and rent revenue, which is a revenue account, gets credited in order to increase it. Okay? So one more thing for us to note. In each adjusting entry, we need to have at least one income statement account, revenue is an income statement account, and one balance sheet account. Unearned rent revenue is a liability. So at least one income statement, at least one balance sheet account is affected in the adjusting entry. What happens if we don't do these adjusting entries? So I'm going to go back to the previous slides and see what happens if I don't do the adjusting entry. So if I did not do this adjusting entry, at the end of the month, I have not recognized an expense, which means the expenses are understated. My prepaid rent should be only $11,000 at the end of the first month, but if I don't do the entry, it will still show $12,000, which means my asset will be overstated. Let's look over here what happens if I didn't do this journal entry. My revenue will be understated because I'm not recognizing the revenue, and my liability will be overstated. So always if the question, you're asked a question, what's the effect of not doing an adjusting entry? Think about what the adjusting entry is, and then you can answer the question very easily. So clearly there are issues if you don't do adjusting entries. You're going to be either understating or overstating the accounts that are affected, and that clearly is going to flow through into your income statement and your balance sheet, and your financial statements will be misrepresented. So after you've done all your adjusting entries, you will post it into the ledger and then create a trial balance, which is called the adjusted trial balance. The trial balance again serves to prove equality, that debits and credits are equal. And this is the basis on which you prepare your financial statements. So let's look quickly at the adjusted trial balance and how the numbers flow through into the financial statements. So if you see over here the adjusted trial balance, the accounts are listed very neatly, and by neatly I mean in order. We have all our assets listed, then liabilities, then equity, and then you have retained earnings, dividends, revenues, and expenses. How would one come about with this so neatly in this particular order? The reason this happens is Companies, instead of relying purely on account names, they have account numbers. So when they number accounts, all the assets are in the 100s. If it's a smaller company, it'll be only 3-digit numbers, so 100. So cash will be 101, accounts receivable is 102, 103, so on and so forth. Your liabilities will be 200s, your equity is 300s, revenues is 400s, and expenses are 500s, and that's how they all get listed so neatly over here in the adjusted trial balance. So what do we do with all these numbers? I take all my revenue and expenses, and those go in the income statement. The revenues and expenses go into the income statement. The net income number that results from the income statement comes into the statement of retained earnings for a corporation. If it was a sole proprietorship, it would be a statement of owner's equity or owner's capital. So we have retained earnings beginning balance that's brought forth from the trial balance, add the current year's net income number, subtract any dividends if they are paid. That gives you retained earnings ending balance, and that's going to go into the current year's balance sheet. So let's look at the next slide. We continue with the same adjusted trial balance. Now all of these items have been taken care of there at the bottom. Now let's focus on the top. Your assets, liabilities, and owner's equity are listed in the balance sheet. The retained earnings number came from the previous statement. So this adjusted trial balance is really very handy to prepare our financial statements. What happens after we prepared our financial statements? We close all our temporary accounts. What are temporary accounts? All your revenue accounts, all your expense accounts, and any dividend account you may have. We close these out, and only the permanent accounts stay in your books. So how do we close these accounts? Normal balance for all revenues is credit. Normal balance for all expenses is debit. So you do the opposite and you close them to income summary. This is a temporary account that's created for a few minutes. So income summary is going to be credited, revenue will be debited. That way you close down all the revenue accounts. When we say close down, it means it has a zero balance. Income statement will be debited, all the expenses will be credited. Then whatever is the balance in the income statement account, that is closed out to retained earnings. And dividends are also closed out to retained earnings. So effectively, all of these should have zero balances. When we start the next year, you start with zero balances in all of these accounts. It's kind of like your transcript again, drawing to that, back to that example that I gave you. Every semester, you start with a fresh GPA. That is, you have no GPA and you earn a GPA for the term. This retained earnings number that's still sitting in the balance sheet, it's more like a cumulative GPA. It keeps adding, it keeps going in over there. But these are all just for the particular period. It's like the term GPA, what you got in the current term. Okay, the purpose of the post-closing trial balance is again to prove equality of all the permanent accounts that the company needs to carry into the next period, and all temporary accounts have a zero balance. So once again over here, the emphasis is that we have to clear out everything at the end of the current period. So once again, let's take a look at our accounting cycle. A business transaction happens, we journalize it, that's record in the journal, post in the ledger, prepare the trial balance. At the end of the period, you do your adjusting entries to make adjustments to the deferrals and accruals. Prepare the adjusted trial balance, prepare financial statements, prepare the journal entries to close all your temporary accounts, and then finally prepare a post-closing trial balance. That'll then give you a fresh start for the following period. So this cycle obviously goes on continuously as long as the business stays functional, they are operational. So this has given you an overview of what we do in financial accounting, specifically what we do in bookkeeping. The next chapter, we move on to merchandising operations. So far, we've looked at service businesses. When you look at a merchandising business, what you have to look forward to is inventory. And that's key to the survival of any merchandising or retail business. So with that, we conclude chapter 4.